Hi everyone, welcome to the Joy Network where just owning you is your responsibility. Today we are going to be talking about investing, what it is, and how it could benefit you. Imagine one day you decide to build a garden. So you go out, buy a book on how to grow your own garden, maybe go online, read a few blogs, or even watch some YouTube videos on the subject. So you take the knowledge you just learned, sit down, and make a plan. How big you want it to be, where you want it, what type of garden you want, what are you going to plant in it, and what is the best time weather-wise, and when you want to start. After you get done building your plan, you take action and go out and buy all the tools and resources you will need. With all the necessary preparations completed, you plant your first round of seeds. Every day around the same time, you come out to water your garden. You do the same thing for about a couple weeks, and then your garden begins to bloom. What was once an empty area with no plants became a colorful garden of different flowers. The fruits of your labors has paid off, and you're now responsible for maintaining the beautiful flowers you've grown. Investing is a bit like that. It starts with an idea, like you wanted to build a garden, followed by research, like studying books and or examples online. Afterwards, planning, which was creating the garden plan and the rough idea of what you want out of it, then taking action by actually planning it, along with constant attention and investments of resources like your time and labor, such as weeding it and watering. Eventually the garden will bloom, and when it does, you maintain it. The longer you maintain it, the healthier, stronger, and bigger it will grow. Disclaimer: this is not financial advice. This video is intended for entertaining and educational purposes only. Please do your own research in regards to any investment you decide to undergo. The Merriam-Webster Dictionary defines investing as to commit money in order to earn a financial return. This is true, but I think it would be fair to add time and energy along with money to that definition as well. See, when you invest, no matter what you're investing in, it is going to require resources outside of just money. Your time and energy spent learning and grinding will be just as important, if not more so than money alone. Not to mention the ability to increase your return on investment by being more involved in your prospective investments. But at this point, you're probably wondering, okay, why do I need to invest and how does this benefit me? Let's first start off by clarifying some terms, starting with investment. An investment is something that you can contribute some form of resource to in the hopes of earning some type of return, in most cases money. There are going to be different types of investments that we will explore later in this video, but for right now I want to get you up to speed on what some of the basic terms are first. Another term is ROI, or return on investment. This is used as a way to evaluate how well an investment is doing. Let's say you invested $100 purchasing stock shares in a company called Phil's Pizza, and you sold them at a later date for $110. The value when sold, $110, minus the value when bought, $100, equates to a profit of $10. You then take the profit and divide it by your initial investment, which will equal 0.1 or 10%, which means your ROI is 10%. Simple, right? Now I want you to imagine if you had a couple of baskets. These baskets are going to represent something called an asset class, which is basically a group of investments that share similar qualities. Inside these asset class baskets, you have eggs. These are going to represent your actual investments. You have some real estate eggs, a couple of company stock share eggs, a few commodity eggs, a handful of bonds eggs, maybe add a business egg in there, and even some cash eggs. When you place all these baskets next to each other, they represent something called an investment portfolio, which is an overview of all your investments that you currently own. At this point, you're probably wondering why I have all these eggs in different baskets and not in the same. Well, this touches on another important term called diversification. See, while you can technically have all your money in one asset class basket, doing so will increase something called risk. When you diversify assets, you're essentially minimizing your risk. What this means is if something happened, like stock market crashes or the business you own shuts down, you have other assets that can help compensate for those losses. The first asset class I want to mention is real estate. The short definition of real estate is properties consisting of land and buildings. Okay, so how do you invest in this asset class, and what can you expect from investing in it? Well, first thing to mention is that real estate, like every other asset class we're going to mention, has a lot of complexity. So diving into all of it will just be too long, so here's the short. You can be a landlord. You essentially purchase a building like a house or a multifamily unit, maybe give it some light updates, and then later search for tenants who can live in the building and pay rent. Chances are when you buy a property, you're taking out a loan called a mortgage. Your tenant's rent then helps pay down that mortgage, which does two things: decrease the amount of money owed on the loan while simultaneously increasing the equity in the building. You may even be able to earn some cash flow from the property. For example, if all the expenses to upkeep the home is $1,200, mortgage included, but you charge $1,500, you will make a $300 profit. Another way to invest in real estate is by participating in something called fix and flip, or flipping. You would buy a property at a relatively low price, maybe something that needs some updating and fixing, and later selling that same property for a higher price. How you sell for a higher price comes in two types: updates that you've done to give the house more value, and the appreciation in value of the house mainly due to its location, like being in a more desirable neighborhood that people are more likely to pay a bit more of a premium to live in. The last type of investing in real estate that we are going to mention are REITs, or real estate investment trusts. So this one is a bit of a mixed bag. You are participating in real estate, but you aren't directly being involved in said real estate. Why? Well, let's explain what a REIT is. These are created by corporations or trusts that raise money from investors, aka you, and use that money to purchase and or maintain property. In return, you get a partial ownership in the property. Here's the simple explanation. You buy a piece of paper that says you own a percentage of the property, either land, building, or construction. So why invest in this type of, investment? While you don't own the entirety of the property or even physically see it in some cases, they provide two benefits. One, they are liquid, meaning you can sell your ownership in the property relatively easier and faster than selling an actual property, since with property that you own, you need an agent, contracts, negotiations, closing costs, and a whole bunch of other things. The second benefit is they pay you for owning it, sort of like dividend stocks. How often you get paid is usually handled by the corporation or trust that created the REIT. And there's your quick explanation of the real estate asset class. Now we can move on to our second asset class, equities. So equities can be a bit much to explain, but we are going to focus on the quick and dirty of what they are in the general sense. When you invest in equities, you're buying a partial ownership in a company. Exchanging your dollars for shares, these shares carry a value. That value then changes over time. So what does that mean for you? Well, let's say there's a company called Company X. Their shares are currently worth $10 each and you decide to buy them at that value. Two things can happen at this point. You can experience depreciation, which is the value of the share drops after your initial purchase. Like if they went down to $9 a share, you would have lost $1 in value. The flip side to this is appreciation, which, as you probably guessed, happens when the value of the shares that you own increase beyond your initial buy-in price. If it goes to $11, you made $1 in profit. Another reason to invest in equities is to build some income. And how would you do that? Well, it's called dividends. Dividends are when a corporation pays you to own shares of their company. Crazy, right? When a company earns profits, they typically distribute them to their shareholders, usually quarterly. Do keep in mind that not all companies pay dividends, but the best part about dividends is not only the payouts, but you also benefit from the appreciation as well. How they measure your dividend payout is by something called a yield. And that depends from company to company. Some pay higher yields than others and some pay lower yields than others. It really depends on the company that you're investing in. Moving on to our next asset class, fixed income. To better illustrate what fixed income is, let's create an example. Say the city of Joyland wants to build a parking lot, so they issue a bunch of bonds to raise the money needed to complete the project. The face value of these bonds is $1,000. The maturity date is 10 years, and to further incentivize investors, they offer a 5% interest. Every year for 10 years, you receive 5% on your money that you lent, $50 until the term is up. Once the bond has reached its maturity date, Joyland will return your initial investment of $1,000. So doing the math, you invested $1,000 and over 10 years you received an extra $500 over that time frame, totaling about $1,500. You're essentially lending money and getting it back at a later date with interest. When an entity, either a corporation or the government, is looking to raise money for certain projects, they issue bonds for investors willing to lend them money. Face value is how much a bond is worth and how much you would need to invest in it. The interest is how much money you make on the bonds. Maturity date is when the loan essentially becomes due, also referred to as the termination date. And now that we got fixed income out the way, we can move on to our fourth asset class, commodities. Right now you might be sitting down drinking a cup of coffee or milk, perhaps grilling a burger and placing it on a toasted wheat bun while sitting in your brand new lawn chair. Whatever you're eating, drinking, or using, it was originally comprised of raw materials. Coffee beans, livestock, wheat, copper, silicone, gold, silver, and just about any other type of raw material you can think of is called a commodity. Commodities are what makes up all the things that we use in our life. They are essential, and being that they are essential, they come with some form of intrinsic value. The real takeaway is that they're going to be around for a very long time, and they will always be a necessity. What does that mean for me as an investor, and why should I care? Historically, some commodities have been a great stable hedge against inflation, namely precious metals and energy products. Hedging is what makes investing in this asset class valuable. To hedge is to take a position in one investment to offset the losses in another investment. Let's give a quick example. Say you have $200 that you're looking to invest. For simplicity's sake, let's say you want to buy gold and it is $100 a bar, but you only want to invest half of your money. As a result, you buy 1 bar of gold. Now you have $100 in cash and $100 worth of gold. Over the year, inflation has risen by 2%, which means that your purchasing power of the dollar has dropped by 2%. So while you physically have $100, your actual buying power is now equivalent to $98. Now gold's value has risen by 2%, spiking the price from $100 a bar to $102 a bar. At this point, you couldn't buy any more gold bars with the same $100 because you don't have enough buying power. However, that one gold bar you bought went up 2%. Now it's worth $102. So if you tally your current value of your investments, you're at $202. If you subtract the $2 buying power you lost from your investments or adjusting for inflation, you still have $200 worth of buying power. This is why you would invest in commodities, to help conserve wealth. Leaving commodities, we can finally venture into the final asset class, and fun fact, you probably are already investing in it. Cash. So it might be funny to hear that cash is an investment, but it does serve a purpose. We are mainly talking about fiat currency, and if you don't know what that means, it just means government issued money that isn't backed by a physical commodity. For clarity, this section will be referring to the United States dollar. Prior to August 15, 1971, the value of the dollar was tied to gold. What that meant was every dollar was essentially backed by the physical commodity gold. This was called the gold standard. However, from August 15, 1971 onwards, the American dollar was taken off the standard and essentially turned into a fiat. When this happened, it allowed governments to essentially circulate more money into the economy because now the currency wasn't restricted to the finite reserves of gold. Now, our fiat currency is only valued at whatever we agree it is valued at. So when you look at a $20 bill and you say it's worth, well, $20, that's not necessarily indicative of its actual buying power. But that topic is for another video. So aside from the little history lesson, why is cash an investment? Well, it buys things. At the end of the day, all the other asset classes are typically bought using cash, from real estate to stocks, bonds, commodities, and well, even other currencies. Our economy essentially runs off the circulation of fiat currency, and by acquiring more of it, we are able to acquire more investments, which in turn produce us more money to then reinvest again. The purchasing power of our currency is governed by inflation and deflation. In simpler terms, the increase and decrease of goods and services in our economy. Another factor that affects our economy is hyperinflation, when a government essentially prints more money to pay for its own spending, but again, that is a topic for another video. Going over those 5 asset classes was a doozy, and those were really brief descriptions of each. Investments in any of these classes will require a good amount of research and due diligence on your part. Please never invest in anything because someone told you that this was the best thing to invest in, but because you did your own homework on the subject. Using this opportunity, I want to stress that there is an asset class that is typically ignored in the investing community: education. You can't attach a physical value to this class because, well, it's priceless. Spending time to increase your financial literacy, personal studies and knowledge will net you back returns far greater than any other asset class I have mentioned here. In fact, increasing your education, and I'm not only talking about just school, but rather reading books, attending seminar, shadowing a mentor, and actually applying the knowledge you acquired, will set you up for greater success than one investment could ever do. I just want to take a moment to thank you for watching. If you enjoy the content, please consider hitting the like button and subscribing to help support the channel. Also hit the bell icon if you want to be notified when we release new videos like this one in the future. Thanks.